Hello everyone, my name is Ratibaril Baressa, and my student number is 234122042. In this video, I will explain a fundamental topic in accounting: types of financial statements, their elements, and the benefits, including the cash flow statement. This topic is very important because financial statements are the main source of information for understanding a company's financial condition. Whether you are an investor, a business owner, or a student of accounting, knowing how to read and interpret financial statements will help you make better financial decisions. First, let us understand what financial statements are. Financial statements are formal records that summarize the financial activities and position of a business. These reports are prepared regularly, usually monthly, quarterly, or annually, and are used by different users such as management, shareholders, creditors, and government agencies. They provide insight into how well a company is performing and whether it is financially healthy or not. There are four main types of financial statements. The first one is the income statement, also known as the profit and loss statement. This statement shows a company's revenues, expenses, and the resulting net profit or net loss over a specific period. It tells us if the company is operating profitably. For example, it helps answer questions like, how much sales did the company make? How much did it spend on operating costs? And did it make a profit in the end? The second type is the balance sheet, also known as the statement of financial position. This report shows the company's assets, liabilities, and equity at a specific point in time. In simple terms, the balance sheet shows what the company owns and what it owes. The basic formula used is assets equals liabilities plus equity. Assets include things like cash, inventory, and equipment. Liabilities include debts and obligations. Equity is the remaining interest for the owners after liabilities are deducted from assets. The third important financial statement is the cash flow statement. This report shows the actual movement of cash in and out of the business during a specific period. It is divided into three main sections: cash flows from operating activities, investing activities, and financing activities. Operating activities include cash received from sales and cash paid for expenses. Investing activities include purchases or sales of assets like buildings or machines. Financing activities include cash received from loans or paid as dividends. The cash flow statement is very useful because it focuses on real cash, not just profits on paper. A company may look profitable on the income statement, but still run out of cash if it does not manage its finances well. The fourth type of financial statement is the statement of changes in equity. This statement shows changes in the owner's equity over time, including capital contributions, profits retained in the business, or dividends paid out. It helps track how the value of ownership in the company has changed across accounting periods. Now let us talk about the elements found in financial statements. The main elements are assets, liabilities, equity, revenues, and expenses. Assets are resources controlled by the company that are expected to bring future benefits, like cash, accounts receivable, or property. Liabilities are obligations the company must pay, such as loans or unpaid bills. Equity represents the owner's claim on the assets after all liabilities are paid. Revenues are the income earned from business activities, while expenses are the costs incurred to earn those revenues. The difference between revenues and expenses is the net profit or loss. Each element plays an important role. Assets show what the company has, liabilities show what it owes, and equity shows the owner's portion. Revenues and expenses help determine whether the business is making money or losing money during the period. Finally, what are the benefits of financial statements? Financial statements are essential for decision-making. For business owners and managers, these reports help in planning, budgeting, and evaluating performance. For investors, financial statements show whether the business is growing and profitable. Creditors and banks use them to assess whether the company can repay loans. Tax authorities use them to determine how much tax the business should pay. In short, financial statements improve transparency, accountability, and help reduce financial risk. To conclude, financial statements are vital tools for understanding and managing a business. There are four major types: the income statement, balance sheet, cash flow statement, and statement of changes in equity. Each one provides different but equally important information. They include key elements like assets, liabilities, equity, revenues, and expenses. Among them, the cash flow statement is especially important because it shows the actual movement of money in the business. Together, these reports allow users to make well-informed financial decisions and help businesses operate more effectively. Thank you for watching this video. Once again, I'm Ratubero Baressa, student number 234-12042. I hope this explanation has helped you understand the basic concepts of financial statements and their importance in the world of accounting. See you in the next lesson and keep learning.